Ever feel like picking stocks is just a game of chance, like flipping a coin? What if I told you that a famous financial theory says you're not that far off? Let's talk about the random walk hypothesis. It's a mind-bending idea that could completely change how you see the stock market. Stick around because this might save you a lot of time and money. So, what exactly is a random walk? Imagine a man walking in a huge open field. He takes a step, but his next step is completely random. It could be forward, backward, left, right, or any direction in between. His past steps give you absolutely no clue about where he'll go next. The random walk hypothesis suggests that stock price movements are just like that man's path, unpredictable. According to this theory, today's stock price already reflects all the publicly available information from the past. All the news, all the earnings reports, all the analyst ratings, it's all baked into the current price. This means that trying to predict future prices by looking at past price charts, a practice known as technical analysis, is basically useless. The next price change isn't influenced by the last one. It's a random response to new, unpredictable information that hits the market. Think about it. A surprise announcement from a company, a sudden political event, or an unexpected economic report. These are the things that move prices. By definition, these events are new and couldn't have been predicted from old data. So the stock price walks randomly as it reacts to this stream of fresh, unpredictable news. This idea is closely tied to what's called the weak form of the efficient market hypothesis, which states you can't beat the market using historical price data alone. Now, let's get practical. What does this mean for you as an investor? If the random walk hypothesis is true, it suggests that spending hours analyzing charts to find patterns might be a waste of time. The head and shoulders pattern or the double bottom you think you see might just be random noise. It also means that trying to time the market, selling right before a dip and buying right before a surge, is an incredibly difficult, if not impossible, game to win consistently. So, should we all just give up and put our money under the mattress? Not at all. The theory actually points towards a very sensible strategy: diversification and long-term investing. Instead of trying to pick individual winning stocks or time the market, it's often more effective to buy a broad basket of stocks, like through an index fund or an ETF. These funds track a whole market index like the S&P 500. By doing this, you're not betting on one company's random walk. You're participating in the overall upward trend of the market over the long term. Historically, while individual stocks are unpredictable day to day, the market as a whole has tended to grow over decades, driven by economic growth and innovation. So, you capture that long-term growth without stressing about the daily random noise. Of course, the random walk hypothesis isn't without its critics. Some argue that there are market anomalies and psychological biases that create predictable patterns. Behavioral finance, for example, studies how human emotions can lead to irrational market behavior, which can sometimes be predicted. And some professional investors do consistently beat the market, although they are the rare exception. But for the average person, the core lesson of the random walk hypothesis is incredibly valuable. It encourages humility and a focus on what you can control. You can't control random market news, but you can control your investment strategy, your costs, and your emotions. Embracing a simple, diversified, long-term approach can be a much more peaceful and often more profitable journey than trying to predict the unpredictable. So, next time you see a stock chart that looks like a wild roller coaster, remember the random walk. Maybe the best move isn't to try and guess the next turn, but to simply enjoy the ride over the long haul. Thanks so much for watching. If you found this explanation helpful, give this video a thumbs up and hit that subscribe button for more simple insights into the world of finance. See you in the next one.